So let's talk about taxes. Now, you might be thinking, taxes? But I thought this was a retirement account. Aren't retirement accounts tax free? And yes, as we mentioned in our account options video, a solo 401k or EQRP retains complete tax free status. But unfortunately, if you'll be using a self directed IRA to passively invest, there are taxes involved, so we need to learn about this concept to better understand what we're investing in. Luckily, I've figured out a way to keep this concept really simple, so let's get started. The two concepts involved are UDFI and UBIT. We'll begin with the first of these two. UDFI stands for Unrelated Debt Financed Income. To get a better understanding, let's check out this phrase. Starting with unrelated, in this situation, it just means not yours, or not from your retirement account. In other words, you're bringing in funds from elsewhere. Debt financed is pretty obvious. It just means deriving from debt or a loan. And finally, we have income. So in whole, the concept means any income derived from using debt brought in from outside your retirement account. When Congress created the IRA in 1974, the intent was to incentivize you to use your IRA or tax deferred dollars to save for your future self. So by borrowing money from a bank or any lender, our tax deferred dollars are benefiting from the use of non tax deferred dollars. The IRS is okay with this, they just say you need to pay tax on this type of behavior. And the income generated from this type of behavior is called UDFI, while the tax that you end up paying on this is called Unrelated Business Income Tax, or UBIT. So let's discuss how this is calculated. Here we have a nice big multifamily building that we just bought. We purchased it with a 25% down payment, which is illustrated up top in light blue. And on the bottom, the bank supplied us with a loan to come up with the rest of the purchase price. Obviously, this works out to 75%. So the top 25% is your equity, and income derived from your equity is never taxed. We don't have to worry about gains, losses, depreciation, or anything like that with this portion of income. The 75%, on the other hand, is leverage coming from outside our IRA. So any income that this portion of capital generates is considered UDFI. We'll have to pay UBIT on this portion. Now, the nice thing about this is because it's income derived from someone else's money, this portion of income can actually make use of its leveraged share of losses. So we can take advantage of depreciation, operating and interest expenses, or really any other expense or loss generated by the property. In the first year, we can use approximately 75% of those losses and expenses, and as the debt is paid back, this number begins to change. So as you can imagine, this helps to offset UDFI and reduce the taxes that you need to pay. If you're interested in seeing what these taxes look like and how much they might affect your investment, check out our case study video where we walk through returns and taxes on a past project.